devastate American businesses through climate policies. Go to China and spend more time talking about climate policy than we do IP theft. I know this sounds like a lot, but you've been given an awesome responsibility to improve the economy, protect Americans, and lead us to a better future. Instead of that, we've seen proposals that allow for this government to spy on Americans' accounts with as little as $600 of transactions. I'll end with this. Under your jurisdiction is the Financial Crimes Enforcement Network, or FinCEN. And we have seen and heard of abuses from FinCEN, using their power to track Americans for shopping at sporting goods stores, purchasing Bibles, and making transactions with political keywords. In fact, I sent a letter to you just a few weeks ago, specifically asking about these allegations, that the Treasury Department should provide materials to have been providing materials to financial institutions, instructing them to search Americans' financial transactions using terminology that reveal political interest. I would love to hear a response to that. If true, this is a gross abuse of power. FinCEN was created to stop money laundering and not to spy on Americans. It was not created for political motivation. So I conclude with this. America deserves better than what the Biden administration, the Department of Treasury, has delivered to them.
Senator Scott. Janet, Secretary Yellen, Secretary of the Treasury, please proceed. Thank you for joining this committee again.
Thank you. Good morning. Chairman Brown, Ranking Member Scott, and members of the committee, thank you for inviting me to testify. Over the past 3 years, the Biden administration has driven an historic recovery. GDP growth is strong, and inflation has declined significantly. We've also achieved a healthy labor market. The prime age labor force participation rate is up by over 2 percentage points from January 2021. The unemployment rate remains below 4%, continuing the longest streak in 50 years. Real wages have increased. Household median wealth has too, by 37% between 2019 and 2022. That's the largest 3-year increase on record. Families are now putting their additional income and accumulated savings back into the economy. Our continued economic strength depends on a solid and resilient U.S. financial system. Throughout 2023, the Financial Stability Oversight Council monitored a wide range of risks, including risks stemming from commercial and residential real estate sectors and from global geopolitical conflicts and technological developments. When 2 regional banks failed last March, we acted quickly to prevent contagion to banks with similar vulnerabilities and to maintain confidence in the banking system. The Council also increased transparency this year, issuing an analytic framework that for the first time provides the public with in-depth information on how it monitors, assesses, and responds to potential financial risks. Let me now highlight 5 areas of ongoing work that are further detailed in the Council's 2023 annual report. First, the Council is focused on risks from the banking sector and from non-bank financial institutions. It supports member agencies' plans to review whether capital measures appropriately reflect the banking institution's ability to absorb losses, improve resolvability at large, complex, or interconnected banks, and address vulnerabilities from uninsured deposit levels and depositor composition. Non-bank financial institutions are an important source of capital in financial markets, but also pose potential risks to the financial system, including risks related to liquidity mismatch and leverage. Securities and and Exchange Commission initiatives focused on hedge funds, money market funds, and other investment funds are an important step forward here. Second, the Council is focused on member agencies enhancing assessment efforts and increasing coordination around climate-related financial stability risks from increasingly severe and frequent climate-related events. Financial regulators should also continue to promote disclosures that allow investors and financial institutions to consider these risks in their investment and lending decisions. Third, a key focus has been bolstering protections against cybersecurity risk. The Council promotes sharing timely and actionable cybersecurity information, including through ongoing partnerships between state and federal agencies and the private sector. Fourth, the Council is closely monitoring the increasing use of artificial intelligence in financial services, which brings potential benefits such as reducing costs and improving efficiencies, and potential risks like cyber and model risk. Financial institutions, regulators, and market participants should continue deepening their expertise and monitoring capacity in this area. And fifth, the Council is focused on digital assets and related risks, such as from runs on crypto asset platforms and stablecoins, potential vulnerabilities from crypto asset price volatility, and the proliferation of platforms acting outside of or out of compliance with applicable laws and regulations. Applicable rules and regulations should be enforced, and Congress should pass legislation to provide for the regulation of stablecoins and of the spot market for crypto assets that are not securities. We look forward to continuing to engage with Congress on this. With this overview, I look forward to taking your questions on these and other areas.
Thank you, Secretary Yellen. Secretary Yellen, again, has been very flexible in scheduling this. We moved the hearing to 9 o'clock because she wanted as much time as possible. She has to leave by 11:30 exactly. I will enforce the 5-minute rule on myself and on everyone else. Last March, you and the banking regulators, after a banking crisis, had to step in and stabilize the system. It's a pattern we see all too often. Executives take outside risk to enrich themselves and rarely suffer consequences. 14 years ago, Congress gave FSOC important authorities to impose safeguards of the biggest, riskiest non-bank financial firms. Secretary Yellen, why are FSOC's designation authorities important for ensuring that Wall Street is accountable when it puts our financial system at risk?
Thank you for that question. I think if we look back to the financial crisis in 2008 and recognize that in some investment banks like Lehman Brothers that were not banks at all, but rather shadow banks or non-bank financial institutions, had very little capital and were immensely highly leveraged. And their failure touched off a financial crisis, the likes of which we hadn't seen since the Great Depression. As you mentioned in your opening comments, the toll that this took on American workers and businesses was utterly enormous. The unemployment rate rose close to double digits, and it took almost a decade to recover from that. And so making sure we, of course, focus on the banking sector, but there are non-banks that can pose risks to their material distress, or their failure can pose tremendous spillovers and risks to the entire financial system. And when the Council identifies such a firm, designation may be the appropriate way to handle that. And Dodd-Frank created an ability for FSOC to designate such firms for supervision by the Federal Reserve, and they need to have higher risk management, capital liquidity standards.
Thank you. And we again assert that FSOC should follow through in its non-bank designation guidelines and make sure there's appropriate oversight of these companies. We know that terrorist groups like Hamas, Al-Qaeda, and Hezbollah have used digital assets to raise and transfer funds. We have important tools to counter illicit finance, but most of them date back to the post-9/11 era. As terrorists continue to innovate, do we need to update our counterterrorism tools, Madam Secretary, to respond to the risks created by digital assets?
We do have authorities, many authorities, that enable us to act, but we've identified a number of holes in our authorities and have composed a list of suggestions for ways in which Treasury's authorities could and should be strengthened, and we look forward to working with you to try to accomplish that.
We will work with you on that. Some of it you can do as the Secretary of the Treasury. Much of it needs congressional authority. We will absolutely work with you. You've been cooperative all along. We will continue. My last question, it seemed like almost overnight last March, we learned the actions of a few executives, bank executives, put the whole system under stress. Thankfully, the system stabilized. But I think as a lesson is that risk to our banks can build up and suddenly emerge without much warning. It's what happened last year. When our banking system faces unexpected stresses, explain to us how strong capital rules reduce systemic risk and help to protect depositors and small businesses.
Well, capital is available to absorb losses from unanticipated shocks. What happened last March is that a couple of banking organizations that had really mismanaged their interest rate risk, which is a classic risk, something in a rising interest rate environment can lead to either realized or unrealized losses for banks. Strong capital enables these banks to remain viable, not to fail. And unfortunately, Silicon Valley Bank touched off, it had enormous uninsured deposits, inadequate liquidity, and when it suffered these losses, it suffered a run. And that run threatened similar runs at other institutions that also had exposure to uninsured deposits. So the President and the Treasury and the regulators took actions to try to stem a systemic bank run. And I believe we were successful in accomplishing that.
Thank you, Madam Secretary. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. And Secretary Yellen, welcome to the committee. Senator Lummis had headed up a letter where there are 8 of us that had sent a letter in asking that you would commit to a timeline for publishing FSOC's Section 123 report on the economic impact of regulation to address systemic risk. The analysis is critical at a time when financial regulators are pursuing complex changes to all parts of the financial system. The report is 3 years overdue, and your response to the letter would be requested fairly quickly. I would encourage you to direct the Council to meet its statutory obligations in the next 6 months, and I would ask unanimous consent from the committee, Mr. Chairman, that the letter be entered into the record. Thank you, Mr. Chairman. Madam Secretary, I'm just going to start out, like I said, I got to ask you an easy one first. The FSOC 2023 annual report stated U.S. banks to continue to have sound levels of regulatory capital and healthy levels of profitability while maintaining ample liquidity buffers. As the chairwoman of the council, I think you would probably agree with the statement, correct? Okay. I also know that in the past you've been very careful not to get into the middle of discussing the Basel III endgame discussions. I presume at this stage of the game you don't want to comment on that at this point.
That's correct.
Okay, thank you. Nonetheless, it does seem to me that the fact that we make it very clear that the banks right now have sound levels of regulatory capital and healthy levels of profitability while maintaining ample liquidity buffers would seem to suggest that we may not need a whole lot of additional changes with regard to the Basel III endgame proposals. Secretary Yellen, fair to say that probably our government is not on a fiscally responsible path right now?
I do believe we need to reduce deficits and to stay on a fiscally sustainable path. Thus far, in real terms, the interest burden of the debt has remained within or below historical norms. And the president's budget last year suggested substantial deficit reduction that would continue to hold the level of interest expense at comfortable levels. But we would need to work together to try to achieve those savings.
Recognizing as part of the administration that that's part of the messaging that's out there, but it seems to me that the debt service costs on the Treasury securities increased by $237 billion year over year. Doesn't hardly seem to be sustainable.
Well, short-term interest rates have risen considerably as the Fed has tightened monetary policy. The expectations of, and actually long-term rates have risen too, but by somewhat less. The expectations of most forecasters and of CBO's recent analysis suggested that while interest rates are expected to be above the very low levels that they were at prior to the financial crisis, they are expected to decline somewhat.
I'd like to explore that just a little bit. My understanding is that to accommodate for the rising cost of servicing our debt, the Treasury Department announced last week another increase of its longer-dated debt auctions. If we don't course correct, the federal deficit may very well reach a point where no one's willing to take on our government-issued debt. Is that a possibility?
It could, in an extreme case, be a possibility. I see no sign of that now. Our debt is highly valued, is the soundest and most liquid asset, not only for Americans, but around the world. But of course, we need to stay on a fiscally sustainable path.
But no, also if the Treasury auctions are such that perhaps there is less interest in that debt, would the Fed have to restart quantitative easing to accommodate it? And would you expect quantitative easing to be a part of the plans in the near future, the next 2 years?
Well, I'm not going to comment on what the Fed will or should do. I would simply say, as you know, the Fed's responsibility is to maintain full employment and to hold inflation down. And I think that they would attempt to fulfill that congressional mandate.
Thank you. And these 5 minutes go by real fast, but thank you, Madam Chair.
Thank you.
Senator Reid of Rhode Island's recognized.
Thank you very much, Mr. Chairman. Welcome, Madam Secretary. And let me commend you first for you and President Biden for a remarkable job. Unemployment is now 3.7%. It's been that way for 24 months. That's the longest stretch since 1960. So this administration has surpassed many administrations previously, both Republican and Democrat. Gross domestic product, GDP, is growing. And we've got an expansion of the labor force. So by most statistics, and I would add, real wages have also grown. Is that correct? So, and we're seeing particularly the growth of real wages in minority communities, which frequently are the last, if they ever get the benefits of expansion.
Yes, it's one of the fairest expansions we've ever seen, with disproportionate gains at the low end.
And that is a reflection of the policies that the President Biden has taken, along with you, investing in the economy, of creating jobs, not simply hoping that it all trickles down from the select few.
That is absolutely correct.
Well, thank you very much. Let me change topics for a moment here. The Treasury Department released its annual National Money Laundering Risk Assessment for 2024, and the assessment notes that investment advisors to private funds, such as hedge funds and private equity funds, pose the highest risk of money laundering because they are exempt from AML, the anti-money laundering regulations. Can you describe the assessment, and does this represent a danger to the United States?
Well, I believe it does represent a danger to our financial system, and it creates holes that facilitate illicit financial activities. Investment advisors have never been subject to comprehensive industry-wide AML CFT regulations, and at this point there is a kind of patchwork where some investment advisors implement some measures. Some of them are duly registered as broker-dealers or part of financial holding companies, but there are holes in this system which allow illegitimate or illicit investors to shop around for an investment advisor who doesn't inquire into their source of wealth. And Treasury is planning to issue a proposed rule that would apply AML-CFT requirements to investment advisors.
So essentially, it appears that some of these advisors who aren't subject to regulation are taking the money of Russians, Chinese, et cetera, and moving it through hedge funds and essentially washing it here in the United States.
That's absolutely correct, and we have identified instances where investment advisors have worked with sanctioned individuals, corrupt officials, tax evaders, and criminals, and this is really a risk to us and to the globe we need to address.
Now let me again switch gears. One of the issues I think we all face in our particular metropolitan areas is the falling demand for commercial real estate, which puts pressure on the banks that have lended to the developers, which puts pressures on the developers. Is the FSOC looking at this in a comprehensive way and its impact on both the real estate sector and also the banking sector?
We have been looking at it in a comprehensive way and working with the bank supervisors to understand exposures. I believe we have discussed at almost all of our FSOC meetings this year, commercial real estate, and gotten reports and done our own analysis. And you're right that particularly for office buildings in metropolitan areas, vacancy rates have gone way up, especially for other than Class A buildings. And of course, interest rates are substantially higher, valuations are falling, and so it's obvious that there's going to be stress and losses that are associated with this. The banking supervisors are working with their banks to manage this risk, to identify it. I believe, this will not end up, I hope and believe it will not end up being a systemic risk for the banking system. The exposure of the largest banks is quite low, but there may be smaller banks that are stressed by these developments.
Thank you, Madam Secretary, very, very much.
Thanks, Senator Reid. Senator Kennedy of Louisiana is recognized.
Madam Secretary, I've watched you for years, even before I came to Washington. And
Excuse me, Bob. It's okay.
when I have time, I do. I enjoy reading your speeches. I think you're what cool looks like. You're a good sport to go out every day and try to defend Bidenomics. It's like trying to defend a fungal infection. Bidenomics is really just paying more to live worse, isn't it?
I certainly wouldn't agree with that characterization. Bidenomics first tried to address the pain that households were experiencing because of the pandemic and to help them survive it. Small businesses, households, people who had lost their jobs, to prevent the kind of scarring we saw after the financial crisis. And as the economy began to recover, and we quickly, of all advanced countries that experienced the pandemic, no country has done better than the United States in quickly having a labor market recovery, resuming growth, and we have the largest real wage increases of any advanced country. And then medium term, Bidenomics is focused on helping middle-class families lead better lives, address the problems that they have, create jobs
Could
in
I interrupt
areas.
you, Madam Secretary, because I've only got 5 minutes. Good try. These high prices are here to stay, aren't they? Let me amend that, Madam Secretary. These high prices caused by Bidenomics are here to stay, aren't they?
Well, the high prices were not caused by Bidenomics. We suffered a pandemic that resulted in severe dislocations.
Yes, ma'am, but if I could ask you, they're here to stay, aren't they?
I don't expect the level of prices to go down, but the rate of inflation.
So they're here to stay.
Well, some prices will be higher than they were before the pandemic and will stay higher, but wages have risen considerably, and the pace of price increases has now receded. Over the last 6 months, the measure of inflation the Fed focuses on has been running exactly at
But if your
2%,
wages
and wages are going up.
you don't get a pay raise, you're screwed. I mean, there's a difference between disinflation and deflation. Y'all talk about disinflation, which I'm happy to have. Disinflation means inflation is going down. It means prices are rising less rapidly than they were. But that's a far cry from deflation, which means the level of these high prices caused by Bidenomics are here to stay. Here's what Jay Powell just said on February 4th. He said, he was asked the question, inflation is one thing, prices are another, and I wonder if there's any reason to believe that people will see the prices of things decline. And here's what Chairman Powell said. So the prices of some things will decline, others will go up, but we don't expect to see a decline in the overall price level. That doesn't tend to happen in economies, except in very negative circumstances. He's talking about a recession. It'll take a recession to get these prices down.
Well, we don't have to get the prices down
We
because
don't?
wages are going up, and a metric that is worth knowing is that the median American house worker
But let me stop you
is
because I'm
able
going to get cut
to
off.
buy
You don't
the-
think we need to get these prices down? You think it's okay that bacon's up 20% under President Biden? Chicken's up 23.5%. Coffee's up 30%. Gas is up 44%. New cars and trucks are up 20% because people can't afford that's used cars because people can't afford a new car. They're up 24% under Bidenomics. You don't think we need to get these prices?
Wages are also up, and wages are up
They're
more.
not up 24%. They're not
Well,
up 27%. They're not up 23. They're not up 31.
I'm sorry, but what is...
People are really getting good at barely getting by because of Bidenomics.
Look, American households have many pressures on their budgets, and President Biden is devoted to doing what we can as an administration, whether it's health care costs, insulin copays, energy costs, to getting these prices down and to helping American households afford a decent middle-class life. But what is true is that the median worker in the United States, if you compare today with 2019, can buy the same basket of goods with $1,400 left over to save or spend. So Americans, on average, are better off in spite of the fact that the level of prices is higher.
Thank you, Senator Kennedy.
Good try, madam.
Senator Menendez, New
Thank
Jersey's recognized.
Thank you, Mr. Chairman. Since we're talking about questions of affordability, let's stay in that realm, but talk about something my Republican friends did not support. The American Rescue Plan, which I'm proud to have voted for and provided a historic increase to the child tax credit by boosting the credit to $3,600 for infants and toddlers and $3,000 for children, and paying those credits on a monthly basis. Child poverty decreased by 30% in 2021. In the same year, food insecurity decreased by 24%, the equivalent of 2 million fewer children going hungry. For parents, the CTC helped pay for baby formula, childcare, and so many other things. Unfortunately, this critical lifeline ended for hardworking families across the nation at the end of 2021. Secretary Yellen, is it your opinion that the American Rescue Plan enhanced child tax credit is the reason for decrease in child poverty in 2021?
I believe that a recent study showed that about a half of the decrease in child poverty was directly attributable to the child tax credit, and there were other things that also served to lower child poverty.
And how many more children would be lifted out of poverty if the Bipartisan Tax Relief for American Families and Workers Act was signed into law?
I don't know the exact numbers, but certainly additional children would be.
Based upon what we saw previously and looking at what the credit is devised in that legislation, to me it is a proven track record of delivering brighter future for our children. And I want to thank the chairman for his continued work on this issue. I hope we can pass this legislation shortly. Climate change is causing the property and casualty insurance market to buckle under competing pressures to provide returns for shareholders and sell a product that policyholders can afford. As businesses, insurers have an obligation, obviously, to their shareholders to make a profit. But as policymakers, we have a right to be concerned when families can't afford or access necessary homeowners insurance coverage. Allstate and State Farm have stopped writing new policies in California. 15 other companies have stopped writing new policies in Florida. Insurance giant AIG plans to reduce their homeowners insurance business in communities across the United States: New York, Delaware, Florida, Colorado, Montana, Idaho, and Wyoming. 12% of homeowners have chosen to forego home insurance. So, Madam Secretary, can you discuss, as noted in the report, how climate risk drives a negative feedback loop to economic and financial stability?
Well, we're very concerned about the developments that you just cited. And, of course, the absence of insurance or being priced out of insurance as these climate risks have intensified is harming the well-being of households and the cost of living. And it's also creating risk to financial stability because many banks have exposure through loans to the risks that can come if there are uninsured losses. And so there can be a feedback loop that works to disadvantage.
Between wildfires, droughts, flooding across the country for those who are deniers, you can see it before your eyes. If you have no insurance, then you put, for most American families, is the biggest single asset at risk at the end of the day. And finally, the FSOC report made some mention of the housing shortage when discussing vulnerabilities in the residential real estate market. But I worry that not enough emphasis is being placed on this crisis. Nationwide, we're facing a shortage of 3.2 million homes. This shortage is driving up the price of housing and placing vulnerable Americans such as seniors and those with lower incomes at risk. Do you agree that the housing shortage, if not addressed, could pose a serious threat to the economy? And if so, what do you think that Congress could do to help alleviate that circumstance?
Well, I certainly agree that this is an enormous problem for a very large number of Americans. President Biden has made a number of different proposals to attempt to address this that Congress hasn't passed. And I do think it's an area that requires very close attention and action by Congress to address.
Well, choice neighborhoods, Section 202 housing for the elderly, and a whole host of other things. And the Public Housing Fund is facing a $70 billion capital needs backlog. And the Section 202 program hasn't kept with the rising need for affordable senior housing. So I know the committee has jurisdiction over that. I appreciate the chairman has given housing more attention under his leadership. I hope we can continue to do so.
Thanks, Senator Menendez. Senator Scott of South Carolina, ranking member.
Thank you, Mr. Chairman. Once again, thank you for being here. Certainly, you and I would probably agree on one thing for sure, which is that the United States and a strong United States is a vital part of global security. And one of the challenges I have, as I started my opening statement with, as it relates to the Iranian regime's proxy attacks on our American soldiers, is the fact that this administration, under your leadership in the Treasury Department, has released $6 billion before the October 7th attack, $10 billion after the October attack, and $100+ billion as it relates to the relaxation of the oil sanctions. And that, to me, leads to attacks from the Houthis. It actually is in part because this administration downgraded the Houthis from a terrorist organization, foreign terrorist organization. So when I look at the actions of this administration and I couple that with the resources released to Iran, the question I ask is, how do you continue to provide Iran with billions of dollars, knowing that they are the ones that are orchestrating attacks against our service members? And I assume your answer will in part be that some of those dollars are frozen, even though there have been a couple of opportunities and acts trying to access those resources. But we both understand the fungible nature of money. And so I'd love to hear your answer, number one. Number two, likely, because I've spoken with you before during these hearings, you are very, very good, and therefore I may have to cut you off.
Okay. So first of all, I want to say that the Treasury Department has been extremely aggressive and very vigilant about sanctions on the Iranian regime. We have worked very hard and had many sanctions actions addressed at Iranian oil shipments to try to do what we can to minimize revenues from oil. We have taken many actions in the aftermath of the attacks on Israel to close down channels for Hamas and other Iranian-affiliated groups to use the financial system to fund their malicious activities. So I think the record is clear. We've done a great deal. With respect to
Let me stop there,
funds,
because I do think you and I will not get to an agreement there. I do think that the record is clear that when you look at it, the net effect of the administration's actions has been more resources, more money for Iran, not fewer dollars. But I have two other subjects I want to cover with you. Go right ahead.
could I just
Certainly.
quickly, the $6 billion that you're referring to were Iranian funds that were frozen in Korea. And
Yes.
we permitted these funds to be transferred to Qatar. They can only, when they were in Korea and now, can only be used for humanitarian purposes. And there are strict controls to make sure that they are directed only at humanitarian purposes.
Thank you. Let me
and
just
not
stop you
a
there.
dollar.
Mostly
None of it
because
is
I have
spent.
very little time left, and the chairman is being very tough on us today as it relates to our time. So I will just respond by simply saying that if you give me $600 and I had a need, I would just use other money to deal with the need if you are trying to restrict the dollars. That's why I started the conversation with the fungible nature of dollars. But we do have another issue as it relates to the FSOC designations, the SIFI designations under FSOC. Under your direction, FSOC finalized guidance on a framework to evaluate non-bank financial firms for designation as a threat to our financial stability. If a company meets FSOC's new framework, it would be designated a SIFI and would be subject to Federal Reserve supervision and regulation. In 2019, FSOC issued a common sense proposal on this matter that evaluated firms based on their business activities, required a consideration of the firm's financial health, and perhaps most importantly, would have required the government to conduct a cost-benefit analysis prior to making any such designation. And recently, my understanding is that the way that you've restructured it, that no longer is the cost-benefit analysis necessary. No longer do you use the activities-based approach. Instead, due to, as I quote, unpredictability of the financial crises, such an analysis is not reasonably estimable, useful, or warranted in this context. So when you eliminate actual standards that people can understand and you go to something far more flexible and subjective, I think it makes it even more difficult for companies to figure out when they are in threat and when they are not in threat of becoming a SIFI.
I don't know if I have time to answer this question.
The chairman
Is it
likes
rate-
to
Take your time when you're answering. No, the answer is if, proceed.
We revised the 2019 guidance because it made it all but impossible to designate a firm as a SIFI and deprived FSOC of a tool that Congress in Dodd-Frank clearly intended for it to have. Dodd-Frank does not require a cost-benefit analysis. It could have required it. It chose not to require it, and for very good reason. And you just cited the reason, which is we're talking about some cost to an individual firm, and the benefit is a reduced probability of a devastating financial crisis like the one we had in 2008 that can deprive millions and millions of hardworking Americans and businesses of their livelihoods. And to try to assign a number to what that benefit is, even now, if you ask researchers what is the what was the cost of the 2008 financial crisis, it was obviously huge, but to try to put a number on it is an artificial exercise, and it's clear that Dodd-Frank did not intend it. And with respect to an activities-based approach, the 2019 guidance said that there was a preference for an activities-based approach, and designation could only be used if an activities-based approach would not work.
Thank you.
And there is no preference here for designation. It is not a preferred approach.
I certainly think of you as an expert at saying a lot, but let me just suggest that only the government thinks that figuring out the cost of something is unnecessary, and determining the activities that lead to the threat is unnecessary. That, from a business person's perspective, is remarkable.
Thank you, Senator Scott. Senator Tester of Montana is recognized.
Thank you, Mr. Chairman, Ranking Member, and I want to thank you for being here. I very much appreciate it, Madam Secretary. I want to talk a little bit about Russia and China, particularly China. There is no doubt that they want to replace us as the world's economic leader. I mean, that's a given. It is also a given that they're not going to play fair. They never have, and I don't think they ever will. I am pleased that the FSOC is focused on ensuring that we have appropriate mitigation and response management in place, but it's awfully hard to protect against threats that aren't on our radar. So, Secretary Yellen, do we have a good enough handle on where these threats from our foreign adversaries are directed, and what are you seeing as far as threats are concerned?
Well, you know, FSOC is really only concerned with threats to the U.S. financial system. Now, cybersecurity that could involve China, there may be artificial intelligence we've identified as a threat, but China poses a number of threats that the Biden administration and the U.S. Treasury are concerned about and attempting to address that would not be in the domain of FSOC.
Amen. But from a Department of Treasury standpoint, do you feel you have a handle on these threats and where they're coming from? Because they continually, as it applies to our financial system, military is another situation, cyber is another situation, but as it applies to our financial system, because if they can undermine it, take away our confidence in it, they've gone a great step towards achieving their goal.
Well, we are particularly concerned about cyber threats, ransomware, and AI.
Okay, so let me talk about a different issue that Senator Rounds and I have been working on for a long time, and it is deals with 4 countries. Many of them have been already brought up today: North Korea, Iran, Russia, and China, as it applies to buying foreign farmland. We have a bill. We've asked that CFIUS be really the lead on it, and I just kind of want to get your help on this, because quite frankly, we've got some pushback because CFIUS doesn't think this is in their purview. I personally think agriculture and food is national security, and I think there are dictatorships around the world that use food to control people. I don't want to be in that situation. Otherwise, our democracy will be gone. So the real question is when it comes to buying farmland and agribusiness, does CFIUS have the capacity to be able to analyze and make a determination what's going on?
Well, CFIUS...
as it applies to farmland and agribusiness.
So as it applies to farmland, I believe CFIUS has the ability to review real estate transactions.
They do.
If they're close to
military facility.
identified sensitive
Right.
facilities
I'm talking
or
about
ports.
I'm talking about everything in the United States, not just next to military facilities, which, by the way, I don't think has been done very well. But I'm talking about even if they're buying it next to my farm, if it's a person connected with any one of these 4 countries' government, do we have the ability to make a determination?
Well, we do agree that food security
Yes.
is a national
Yep.
security issue. And I don't know that we would have the ability,
Right.
not near
Yep.
such an installation
To be honest with you, you may not. The question is what does Congress need to do to make it so that they have that ability? Because I think this is a serious, serious, serious problem. What do we have to do to make sure they have that ability? Do we have to fund them more? Do we have to put additional mandates on them? What do we have to do to make sure? Because I think they're concerned about, right now, semiconductors mostly, which I got no problem with that. But when it comes to farmland, agribusiness, what do we have to do to make sure that they're paying attention to this?
You know, for CFIUS to take action
Yep.
on this,
Yep.
I think would require legislation. I know that you've been a leader in
Yep.
proposing such regulation.
Yep.
And I believe the Treasury Department has worked with you. We're certainly happy to.
Yep. So I appreciate that, and it is bipartisan, and I think it is a real threat that we need to take seriously. We just found out about a Chinese billionaire that bought 200,000 acres in Oregon. We didn't know a damn thing about it until after the fact. After the fact, it becomes a problem. We need to be more proactive. Thank you, Secretary Yellen, for being here. Thank you, Mr. Chairman.
And Senator Hester, thank you. And that Chinese billionaire, I spoke to the Farm Bureau in Columbus yesterday or a few days ago, and one of the things we're working on is not just prohibition, but actually having the data. And we will come to you and the administration about how to get that. We have a bill to do it, but it needs to be much more aggressive so we know what they're actually doing with all of their sleight of hand. Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Secretary Yellen. It's so good to see you again.
Thank you.
I very
Nice.
much appreciate the chance to be with you. So I'd like to ask a little bit about some of the broader economic issues that we see ahead of us and maybe respond a bit to some of the questions that Senator Kennedy was asking you. So as the Fed has raised interest rates, a lot of economists predicted, of course, that the economy we'd be well into a recession by now, but that hasn't happened. In fact, the economy has been defying expectations. And this is driven, it seems to me, by historically strong consumer spending also that have really been driving economic activity and growth. And I think, as you were attempting to point out, that since President Biden took office, wages have increased significantly for low and middle income earners. Do I have that right?
That is true.
Right. And I think that last year, nearly 60% of workers saw their wages outpace prices, surpassing pre-pandemic levels. Is that right?
Yes, that is correct.
So actually purchasing power, which is what matters, how much you can buy with the money that you have in your wallet, is up. Is that not true?
Yes, it is. It's up. I think the number I mentioned is the median worker could buy the same basket of goods as in 2019 and have $1,400 left over.
That's right. And I'm not an economist, though I did take macroeconomics in college. And when you have price deflation, that is usually, what that means, in fact, is that the economy is shrinking and people are actually much worse off in that circumstance,
Of course.
Right? That's right.
We've had a good, strong labor market and stellar growth.
Right. And of course, some would argue that the way that some prices have gone up, including food, for example, if you look at those price increases, and then I'm not asking you to comment on this, I'm just observing, you look at those price increases, and then you look at the massive increase in corporate profits, I would argue that seems to be the driver of prices going up more than some of the, more than the investments that the administration and Congress, Democrats in Congress, have made in the American people. But let me get to that, if I may. I'm interested to know what you think have been the impact of those big investments that Senator Kennedy was talking about that I'm really quite proud of. Big investments that we've made in Americans in infrastructure and broadband, in improving veterans' health care, in lowering the cost of prescription drugs, and bringing manufacturing and chips manufacturing back to the United States, for example. So could you talk a bit about what impact that you think has had on the historic recovery in our economy?
So I think the legislation, there's really a trifecta of legislation Congress passed. The infrastructure bill, the Chips and Semiconductor Act, and also the Inflation Reduction Act. We're seeing an investment boom, and it's creating very good jobs for many Americans in parts of the country that just haven't seen a lot of opportunity in recent decades. And the work we're doing shows that a disproportionate amount, both of the infrastructure spending and the investments we're seeing that have been announced because of the IRA, are going to parts of the country where income is below average and infrastructure needs are greatest. So it's spurring job creation, and the benefits are being very widely shared.
And in fact, I think you referred to this in your opening testimony. If you look at the performance of the American economy compared to the performance of other economies around the world, we're doing much better.
Ours is the best.
And we also made significantly more of these sort of broad-based investments in the American people than other economies, other countries did, right?
Yes, we have. I think we've made very impressive investments. And if you just look at the Inflation Reduction Act, you see that it is sparking an enormous boom in clean energy across the spectrum, across the United States.
Great. Thank you, Mr. Chair.
Thank you, Senator Smith. Senator Butler of California is recognized.
Thank you, Mr. Chair, and thank you, Madam Secretary, for your incredible service to our country in such a challenging time. I want to commend you and the Biden administration for the sound economic policies that we have in place. In short, what you have said and what I believe the FSOC report illuminates for all of us is that Bidenomics works. and that we have record low unemployment, robust economic growth, rising wages. To pick up just where Senator Smith left off, I would love to give you the opportunity to say more, to just explain to the American people how these historic investments of the IRA and the American Rescue Plan have contributed to the stronger economy and the stronger labor market, just to give you some time to really delve into that and explain to the American people.
Well, one of the things I think that's been holding our economy back is a failure to invest in infrastructure. We used to be rated among the very handful of top countries around the world in terms of quality of our infrastructure, and our rank decreased because we had highly inadequate investment. And now we're seeing roads and bridges that have been falling apart, where affects commerce. People are caught for hours in traffic jams all across the country. We're seeing new infrastructure be built. And it's not just old infrastructure, but what a modern economy needs. Broadband, both the American Rescue Plan and the infrastructure bill are providing the funding to make sure that every American household has access to high-speed internet. I remember during the pandemic when we would read stories about families driving their kids to a McDonald's and sitting out in the parking lot so that they could do their homework, had access to broadband. That will be a thing of the past. And of course, the Inflation Reduction Act and the CHIPS Act are really making sure that the United States will play a significant role in, it's a matter of national security, of resilience of our supply chains, and making sure that we're creating good jobs in the industries that are going to be powering our economy in the years to come. And we are seeing the bill has very strong wage and apprenticeship standards for the entire clean energy set of investments. So we're making sure that the jobs that are created are good, high-paying, well-paying jobs, and that people get the training they need to be able to fill them. And there are many aspects of this legislation designed to ensure that all parts of the country benefit from it, and particularly parts of the country that just haven't really seen a lot of opportunity, and that would include energy communities that have been dependent on coal and low-income communities where there are special bonuses for investing there.
Great. President Biden committed to the American people that he would build our economy from the bottom up and the middle out, and I appreciate you helping to explain that a bit more to the American people. Two areas, Secretary, that I will just name and give you just a quick opportunity to respond, and we'll submit some further questions to you for the record. Today, right now, as Senator Menendez pointed out in his earlier comments, the climate crisis is really at California's front door. The historic rains, 400 mudslides, 700,000 people without power today. As we sit here, the FSOC report has talked a lot about insurers, them leaving markets all across the country, including California. Yeah. I'd love to get your thought on how non-banking lenders and other sort of non-FSOC government agencies are working to integrate financial and climate data so that we could actually get your, just again, thoughts around how the health of banks and non-bank lenders will be affected by the lack of insurance being available.
Well, we're doing a great deal of work on that. In the Federal Insurance Office, OMB recently approved a survey that will be very granular at the zip code level to understand trends in insurance. The state insurance regulators, the NAIC, plan also to collect similar data. We're working with them, and what we'll get is a very granular understanding of what's happening to the availability and pricing of insurance. Policymakers, I think, as they begin to address what's becoming a crisis here, this is not straightforward to do, but we look forward to working with Congress to see what responses might be appropriate. And it will have an effect on banks. It raises the risks. And we're focused very heavily on the agencies working with the banking community so that banks understand how these developments are impacting. Well, it impacts the losses that a bank would experience from the lending that it's doing and the value of homes and businesses that banks are lending to.
Thank you, Senator Butler. Thank you. Senator Cortez Masto of Nevada is recognized.
Thank you. Madam Secretary, let me follow up on this same conversation because in Nevada we have similar concerns. Quite often it's been declared major disaster due to severe storms, flooding, landslides, mudslides, same thing I heard from my colleague. And one of the concerns I have is the possibility of changes in property and casualty insurance affecting the mortgage markets and home prices, right, that ultimately exacerbate the affordable housing crisis we see in Nevada and across the country. One of the recommendations, and you may have touched on this, is to enhance or establish information sharing protocols among federal and state agencies. What does that mean?
Well, we are going to try to collect data, as I mentioned, the Federal Insurance Office, that gives us a lot of insight into this issue. And
with state agencies as well, is that part of the collaboration?
We would like to collaborate with state agencies. The states are the regulators of the insurance industry,
right, and they have
in the
central
United
data.
States, and they're looking at these issues as well. And in order to reduce burdens on businesses and to make sure we have compatible data, we're trying to collaborate on this effort.
So for that reason, please let us know if we're particularly accessing that state data, and that collaboration is going to be key for us. So let us know how we can help, if any way, please.
Very good, will do.
Thank you. Let me jump back to, I'm really interested, I think many of us are a year later now, how the regulators have worked to strengthen regulation and supervision to address what we saw happen in March 2023, the bank failures. My question to you is in response to the failures of Silicon Valley Bank, Signature, and First Republic Bank. How have the agencies altered their approach to supervision?
So, this is a matter for the individual agencies, but both the FDIC and the Fed have done and put in the public domain reports on what happened. And these reports include analysis of the failings, their own failings in terms of their supervisory programs. And clearly, as I believe they've testified, strengthening supervision so that they address taking more timely action.
And I appreciate that. The question is that happening? In other words, are the bank supervisors, are the supervisors there, are they actually following through on the recommendations that we saw coming out of the FDIC and the Fed?
I believe that they are, but FSOC is not attempting to engage in an independent assessment of the agencies. I think calling up those agencies directly and asking them for follow-up is probably
I appreciate that. It helps to have an independent view of it, but I appreciate that. Let me jump to one final thing here. Non-bank mortgage originators and servicers. I see in the data that I'm sure you see as well, they continue to gain market share from banks over the last 10 years. Non-banks originated approximately 70% of single-family mortgages in the first half of 2023. Does this shift away from banks to non-banks pose a financial stability risk due to non-banks' lack of access to deposits for short-term financing? Is this a concern? Is this something that we should be looking into as well?
Senator, yes, it is. And FSOC is very focused on that because non-bank mortgage companies lack access to to deposits which banks have. They're reliant on short-term financing that may be a lot less stable than deposits. And in stressful times, their credit lines can be pulled. They don't have access to the kinds of liquidity backstops that banks have as well, such as the Fed's discount window. They tend to have very limited capital and loss-absorbing capacity, and mortgage service rights are a less liquid asset. So there is concern that in stressful market conditions, we could see the failure of one of these. And as you said, this has become very, very significant in the mortgage market.
Thank you. Thank you, Mr. Chair.
Thank you, Senator Cortez Masto. Senator Warner from Virginia.
Thank you, Mr. Chairman. Madam Secretary, it's great to see you. I'm going to bounce around a little bit today on a series of questions, so I appreciate you hanging in with me. A number of colleagues have already talked about financing of terrorism. Yesterday, Treasury did issue annual risk assessments for illicit finance in the wake of the horrific Hamas attack. Yesterday's risk assessment states that Hamas is a well-resourced group that garners substantial financial resources from numerous and divisive sources, use complicit virtual asset service providers, and money transmitters through global move funds. The remarkable thing is, back in 2016, the United States put secondary sanctions in place for Hezbollah. But here we are now, 120 days after the horrific attacks of October 7th, and we still haven't put secondary sanctions in place for Hamas, or for that matter, any other foreign terrorist organizations. So we've tried to put an end to that. Together with Senator Rounds, Reid, and Romney, I've introduced Senate Bill 3441, the Terrorist Financing Prevention Act, to help address this program. This would make sure that all foreign terrorist organizations would be covered, and it would be able to have them go after not only their secondary banking, but also their ability to use crypto. I really appreciate that Treasury has helped a lot with technical assistance on this piece of legislation, but I want to give you the opportunity now to speak to this issue and whether you think this kind of legislation is needed, because our understanding is, without it, you can't put in place this full bevy of sanctions.
I would agree that there are limitations that Treasury faces, and we certainly support the aims of the bill. They would help give us authorities that would enable us to better deal with a very significant threat.
I'm going to count that as an endorsement. I'm going to move to another topic, artificial intelligence. FSOC report identifies AI as a major risk for the financial sector. Matter of fact, I've been surprised that we have not seen more use of AI tools on market manipulation already. And I sometimes fear that they may be happening, and they may not be Fortune 100 companies, but Fortune 200 to 500 companies, and we may find that it's happening real time. As somebody that was very involved in Dodd-Frank with the creation of FSOC, I have to say I think its record so far has been a little bit mixed, but boy, oh boy, if there was ever a case to look across all the regulatory entities within the financial sector, a problem like AI, I think would be perfectly suited for FSOC. Again, I've got bipartisan legislation with Senator Kennedy that would have FSOC play that coordinating role on AI, as well as look at some of the issues that already exist in securities law around market manipulation, but increase the penalties if AI tools are being used. So, Madam Secretary, do you agree that this is an area where Congress should move quickly to make sure that we've got a comprehensive approach for both the upside and the downside of AI in the financial sector?
I think the administration would welcome a congressional initiative in this area, and FSOC this year identified AI as a vulnerability that could create systemic risk. So we're working very hard to deepen our understanding of the ways in which that could happen and to monitor very rapidly changing developments to be able to define best practices for financial institutions.
Again, we've worked closely with your office, but I hope you'll take time to look at Senator Kennedy and I's bill. And I think it's at least a good starting point for giving you the tools, and frankly, us having the guardrails. Last question, something I've raised with particularly our friends over at the Fed. As we think about how we prevent future SVBs, and there's been recent reports even now that one of the banks that took on some of the assets of Signature might be having some challenges, is we might need new regulation, but we ought to use some of the tools that are already out there. Discount window. It has been repeatedly reported that the discount window, a lot of these banks that fell into disrepair didn't even have a process in place. I think we need to go beyond some of the guidance that's been given and actually potentially even make mandatory usage of the discount window so we can make sure that it's easily used. I know people are concerned about any kind of reputational risk, but can you speak to this issue and how we can make sure that banks utilize this tool that's been set up since the beginning of the Fed?
Absolutely agree. And inadequate access to liquidity because of a failure by banking institutions to post collateral with the Fed in a timely way. This is something that I think is being reviewed, and it would not surprise me to see new initiatives in this area. So it's a critically important matter.
Thank you, Madam Secretary. Thank you, Mr. Chairman.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. It's good to see you, Secretary Yellen. So today I want to talk about the one percenters, not the billionaires, but the billionaire banks. America has more than 4,700 banks, but the ones that have the power to crash our economy and the ones that get government bailouts are not the community banks. No, the ones that pose a threat are the giant banks, the multi-billion-dollar banks. So the Fed has proposed increased capital standards to make these giant banks hold more capital. And it turns out that even among those billion-dollar banks, nearly 90% already hold enough capital. So what we're really talking about here is just a handful of the biggest banks that would have to hold a little more capital. Secretary Yellen, I just want to start by making sure I've got my facts right. Would the new Basel III rule on capital standards have no impact on community banks and, in fact, only make a handful of giant banks hold more capital?
Well, its terms apply to banks with more than $100 billion or significant trading activities, and community banks have far lower assets, and I'm not aware of any who have those.
So this is not about our community banks.
Not about.
This is about our biggest banks. Why is it so important for these giant banks to hold more capital?
Well, capital is a measure of the resources a bank has to absorb losses in the face of a shock. It's, even in normal times, capital is something a bank has to have in order to lend, and so it's critical to meeting the borrowing needs of households and businesses throughout the economy. When a shock hits, like we saw in the financial crisis, a bank can fail if it runs through its capital. And if it's a large bank or one that is highly interconnected to other financial institutions, its failure can have devastating consequences for the financial system as a whole. The failure of one bank can transmit huge problems to other banks that it lends to or borrows from. They too can fail, and we can see an event like the 2008 financial crisis. And when you have such a financial crisis, it can cause enormous economic toll. We saw that when we hit near double-digit unemployment, when the financial system collapsed. It hits hardworking Americans. It hits businesses that really had nothing to do with any of the activities that caused this.
Okay.
So
higher capital standards are about making the bank safer, but it's about making all of us safer, right, basically?
yes, because it diminishes the odds of a systemic financial
Of a systemic failure. And that's why it's so important for these big banks. And look at what's happening today. Less than a year after 3 billionaire banks collapsed, another one, New York Community Bank, is now teetering. So we're just trying to make sure that these giant banks don't go broke and come back to the American taxpayer like they have done before to get a bailout. But the big banks like JP Morgan, Bank of America, Citi, and Wells Fargo are fighting back hard against these capital standards. They've spent millions of dollars lobbying. They're even running ads during the NFL playoffs, claiming that if they have to be a little bit safer, it will somehow raise grocery prices for American families. You know, in other words, they want us to believe that big banks are really worried about Americans' grocery bills. Nobody believes that. So the question is, what is this really about? The answer is profits. If giant banks have to hold back just a little more capital, that could bite into their buybacks and their executive compensation. In fact, Morgan Stanley recently said it out loud. The banking lobby is fighting to water down the capital rules so that these giant banks can create, quote, a significant increase in buybacks. Secretary Yellen, let me just ask, do you happen to know how much money the 4 biggest banks returned to their shareholders through stock buybacks and dividends over the last decade?
my guess is it's a large amount.
It's a lot
but
of money.
I don't know the exact figure.
I actually looked this up, $630 billion. And do you know how much the average CEO pay at these big banks was in just 2022, just in that 1 year?
Yeah, I'm not sure. My guess would be around 30 million, but
It was 28 million. You're very, very close there. So higher capital requirements may mean fewer stock buybacks. It may mean somewhat smaller bonuses for the CEOs. These giant banks say that they will stop making mortgage loans if they have to hold a little more capital. But I got to say here, who can trust these guys? In 2020, Jamie Dimon at JP Morgan made big headlines when he pledged to make 40,000 mortgage loans to black applicants. 40,000, that's a lot. More than 3 years later, how many loans have they actually made to black applicants? 122. Yeah. So that's what this is all about. The biggest banks want to be able to push hundreds of millions of dollars out the door to investors and CEOs, while the banks take on more risks, and then when things go wrong, and they will go wrong, they want taxpayers to bail them out again. And they claim that if the Fed doesn't cave, people's groceries will cost more. You know, I am sick of bailouts, and I am sick of banks that lie to the American people. We need stronger capital rules to reduce the need for bailouts, and I urge our regulators to finalize these rules as quickly as possible. Thank you, Mr. Chairman.
Thank you, Senator Warren. There is, I believe, Senator Fetterman is on the way and Senator Van Hollen's on the way. So I will just, in the meantime, I want to ask another question. We've had for decades, and I appreciate particularly your interchange with, your exchange, I guess is the better word, with Senator Smith, pointing out the economy in this country versus other countries, pointing out the wage growth in this country. And you know, people were hit hard by inflation. People are, for good reason, are concerned. I think it's clear, though, that a big part of inflation has been all the corporate buybacks and corporate greed and just generally Wall Street predators. I cite often in this committee that the average, the CEO of Stellantis, the old Daimler Chrysler, which the UAW was on strike with or against, the CEO makes 365 times what the average worker makes, and that speaks volumes, I think. Senator Britt of Alabama is recognized.
Thank you, Mr. Chairman. Late last year, I asked various regulators who came before this committee whether they believed our banking system was strong or not. And they all answered yes. So today I would like to start with that same question for you. In your opinion, is the U.S. banking sector strong?
On balance, the answer is yes.
What are you balancing there?
Well, there are some risks, and there are some institutions that will face stresses from commercial real estate that we know was significantly impacted, particularly office buildings, by the pandemic. Interest rates are higher. Loans will have to be refinanced in an environment with higher interest charges, lower valuations, and rising vacancy rates. So, for some banks, this will be a concern. But on balance, I'd say the system is well capitalized.
So one of the things that we've been looking at, and I want to talk about you leading the council, you're obviously the chair of FSOC and its efforts to monitor the risk and vulnerabilities within our financial system, of which you just named a few. I would certainly hope that part of this and part of what you're evaluating is the potential risk that regulations and rules, new rules coming out, the very own agencies that you oversee, what risk those may pose to our economy. I think these regulations could fundamentally weaken the banking sector. And so just want to talk to you about that. Are you assessing that and the implications of these new regulations or rules and what they will do to the American economy?
Well, I think you've raised a very valid issue, but FSOC's charge is to identify vulnerabilities in the financial system and threats that could lead to systemic financial consequences, and not to undertake an evaluation of the cost to the financial sector of actions that regulators have taken. So I don't think we're the right agency to be.
I do hope, though, that you're looking at the cumulative impact of all of these things. It seems that everything is moving so fast. We look at where our economy is right now, and I think that somebody needs to take a step back and take a look at how all of these things layer onto each other, what they do, and then what they do to the end user. This is about everyday Americans. This is about people all across the state of Alabama. And so I'm certainly hopeful that there is somebody that is taking a look in a broad way at all of these things and how they work or don't work, more importantly, together. Speaking of risk, I do want to discuss the U.S. sanctions policy. While I appreciate you being here today, I was frustrated that the Treasury Department did not appear before this committee following the October 7th atrocities that we saw occur across the globe. That was no doubt a day where we saw pure evil. And I want to talk to you specifically about our relationship with Iran. It's no secret that Iran is the world's leading state sponsor of terrorism, providing hundreds of millions of dollars to support terrorist organizations like Hamas, Hezbollah, the Houthis, as well as proxies in Syria and Iraq. They are actively carrying out other atrocities, including attacks on American civilians and service members. We know weakness invites aggression, and if we want peace, we have to do that through strengths. Terrorists are emboldened to target Americans and our allies. It seems that this administration, in the face of that, has doubled down on a strategy of appeasement. My question to you, Secretary Yellen, is after the October 7th attacks, the administration took actions to sanction a number of members of Hamas and operatives and financial facilitators, but obviously that was too little too late. How long had the administration known about the financiers of this terrorist attack prior to the actual date of October 7th?
Well, we have been focused on Hamas and other similar organizations and have been taking actions on sanctions before the attacks. We gained a lot more information in the aftermath of the attacks and have taken many more actions. And we've also been cracking down on Iran with respect to oil shipments, with respect to their petrochemical sector, with respect to steel.
And respectfully, my time is up. I would just say it's not working. We have to go back to a pressure of maximum strategy because right now the Middle East is on fire. Iran is having its will, and we have 3 American service members dead. We've got to move in it.
We're very focused on it and
Senator Fetterman of
doing a
Pennsylvania is
great deal.
Senator Fetterman is recognized of Pennsylvania.
Thank you, Mr. Chairman. Secretary Yellen, I get to talk to one of the leading experts of the economy here. So now I want to talk about this here. Okay, so now President Biden has now brought down inflation, and now last month over 350,000 new jobs, right?
Yes.
And the economy is growing at 3.3%, right?
Yes.
Okay. Unemployment is now at 3.7%.
Correct.
That's pretty good, right?
And it's the longest stretch under 4% in 50 years.
Yeah. In fact, that was 36 months of job growth, right?
Yes.
Yeah. Wow. And of course, real wages are up too.
Correct.
Yeah. And then now the Dow and the S&P 500 are now at record highs, right?
Yes.
Oh my gosh. So the Dow was over 38,600, 3,600. And the NASDAQ is almost 16,000. Right? That's those are record highs. And is it fair to say that our economies and our economy and the recovery is really the envy of the world?
We're doing better than any other advanced country.
Yeah. So yeah, and actually, when I drove myself back to D.C. from Pittsburgh this week, I was able to gas up at under $3 a gallon. We're not talking about gas prices anymore. But now I want to now put that is like now some randoms on TikTok put up videos at McDonald's that they can rig a $16 extra meal. So what is really more reflective of our economy right now? Some kind of a TikTok about McDonald's, or with all those other kind of statistics that I've just been discussing over in this question?
Well, all the statistics you mentioned are highly relevant and by and large extremely positive. It is true that the level of some prices that are important to consumers have risen since the pandemic. One of those would be rents. Food prices are somewhat higher, new and used vehicles. But wages have also gone up. And now inflation has moderated very substantially. And in fact, by the measure that the Fed pays the most attention to, inflation over the last 6 months has been running at 2% at an annual rate. And wages are now going up substantially more rapidly.
2%? 2%?
Is the Fed's target.
Oh my gosh, yeah, wow. Yeah.
So prices are not rising rapidly anymore. Wages continue to. The number I tend to cite is that the median worker in the United States can buy the same typical basket of goods as in 2019 and have $1,400 left over to spend or save.
Yeah, and again, it's remarkable that now people want to talk about some random extra meal at McDonald's for $16, which really is a rigged situation. But now anybody, any fair experts would say that our economy is the envy of the world. And now, what's lost in translation in our national conversation about where we are literally, in our economy versus now some of the other discussions in other parts of the media?
Well, I mean, we do see much more positive surveys of consumer sentiment in recent months since inflation has come under control and wages are rising more quickly. when Americans are polled and asked about a recent poll asking them about their own personal financial situation, more than 60% said they felt good, and more than 60% said they thought 2024 would be a better year. Now, sometimes when people are asked about the economy and how other people are doing, they seem more negative on it, but their own assessment of their own situation, as well as their behavior when it comes to spending or starting small businesses. We're seeing really record small business formation, and that's something that only really occurs when people feel confident about the future of the economy.
Thanks, Senator Fetterman. Thank you.
I did give her a shout out. Like, great job. Thank you. Anyway, so I'm out.
Thank you, Senator.
Thank you, sir. Senator Hagerty, if you'd like to also give her a shout out, I'll give you an extra 30 seconds.
Thanks, Mr. Chairman. We'll see where we land with this. Welcome.
Or more important, if you'd like to give me a shout out, you'll get an extra minute.
I understand. Secretary Yellen, welcome back. Last week, the Treasury outlined its debt issuance plans for the upcoming quarter, and it included some unexpectedly optimistic net funding estimates. And so I have a few questions around that, if I might start there. First, can you explain the Treasury's elevated reliance on bill issuance, which obviously is more costly to the American taxpayer? It's certainly more costly than using notes or bonds right now. Is it because you've got concerns about demand for long-dated instruments, or is it more that you're trying to time where the Fed might go with its rate cuts?
We rely heavily on a regular and predictable schedule of auctions, and we
I understand that. I'm talking about the mix of what you're.
We never try to time the market. We are in there for the long term. We want to make sure that there are not significant surprises for market participants, and so we have quarterly refunding schedules that are well considered and follow that principle. So
I understand, but shortening the duration of the curve, where you are on the curve right now, very short. What's the thought process behind that?
Well, we're close to the proportion that has been recommended by the Treasury Borrowing Advisory Committee.
Does close to mean you're shorter or longer than the recommendation?
I believe we have a slightly higher short-term issuance, but
let's come back to the optimistic funding estimates themselves. The estimates for this coming quarter, I thought they were just released last month, is unexpectedly high. I'm wondering what's driving this next quarter's increased estimate. Is it strong fiscal inflows that you're expecting, or is it merely tax receipts? Is it something structural that you see in the economy that's causing your projection to be higher for this coming quarter?
I can't give you. I need to come back to you with the details. I know we have actually lowered our estimate of the amount that we'll need to borrow in the first quarter. At our quarterly refunding, we indicated we expected to borrow $760 billion in the first quarter and a lesser amount in the second quarter. And actually, this estimate is lower than what we had expected.
No, it's more optimistic as a result. And I'm just trying to understand what you anticipate driving the inflows and why it's just this quarter, why it wouldn't manifest itself in the coming quarters, why those estimates happen.
Well, there are patterns that depend on when we get tax receipts. So as tax receipts come in April, there's less need.
So you're more optimistic the tax receipts will be higher than originally projected?
I'm not. I don't want to. I need to look into it, and I'd like to get back to you with the details.
Let's go to another area. You and I have talked about this before. It has to do with the politicization of what's happening at the Treasury. On multiple occasions, you and I have talked about it. Now there's an IRS contractor that has been actually sentenced for this, leaking confidential tax information belonging to the president, belonging to private citizens, and the presiding judge appropriately referred to what happened as illegal, and he said, quote, "It was an intolerable attack on our constitutional democracy." And I think exploiting the IRS for political purposes is deeply concerning to every American. And in previous hearings, you've referred to this illegal act as very damaging. And I want you to just let me know if you still stand by that statement.
I do. I believe that protection of personal taxpayer information is utterly essential.
Yeah,
and we're devoted to it. And I know that, although I can't give you the details.
I agree with you on that. I just want to point out one thing that deeply concerns me, because even more damage continues to be inflicted on the credibility of the Treasury. If you think about last month's revelation that FinCEN, that's a bureau that's under your watch, directed financial institutions to flag customers who demonstrated, quote, extremist indicators, like the words Trump or MAGA, or whether they made transactions to purchase religious books. This time it's not just an IRS contractor doing it. This is the administration itself taking personal data to target its political foes. Secretary Yellen, do you believe that people that purchase Bibles are extremists?
Certainly not. I want to put this matter in perspective. First of all, FinCEN's mission is to safeguard the financial system from illicit use, to combat money laundering, terrorist finance.
Certainly not to target Americans for purchasing Bibles or voting for Donald Trump.
FinCEN is expected to work closely with law enforcement and financial institutions on their money laundering detection programs. And so there are interchanges and conversations between FinCEN and financial institutions. And I believe that the matter that you are referring to dates back to before my time as Treasury Secretary and in the aftermath of the January 6th attack on the Capitol. Starting in the Trump administration, there were efforts to work with financial institutions to determine what had happened and to work with them to provide relevant information.
And purchasing a Bible is relevant information to determine that these people are extremists. It's ridiculous. It's a shame.
I will get back to you with more detailed information when I've had a chance to study this thoroughly. I want you to understand that this dates back. These were conversations between, I believe, staff at FinCEN and financial institutions that is the purpose of FinCEN. And so the details, I promise to thoroughly investigate.
Thank you, Senator.
Thank
you, Senator.
This is under your charge.
There are a number of things happened between January 1st and January 20th of 2021. Senator Van Hollen's recognized.
Thank you, Mr. Chairman. Welcome, Madam Secretary. Thanks for all the work that you are doing. And I do want to talk a little about the economy and just ask you to reflect on where nonpartisan groups like the Congressional Budget Office predicted we would be in terms of unemployment today, back around the time the president was sworn in, when the pandemic was really in full swing, the economy was hurting, and before we passed the American Rescue Plan.
I must admit, I can't remember the precise numbers, but the impact of the pandemic was expected to be very severe and to last a very long time. And the U.S. economy has done an order of magnitude better than would have been expected by CBO or other forecasters back then. And I do believe that Biden administration policies have played a very important role for that good performance.
Well, it's exceeded all expectations, and as you said earlier in your testimony, certainly surpassed any of our other partner economies around the world. I would like to talk a little bit about the price issue, and you mentioned the supply chain issues, creating bottlenecks that led to price increases around the time of the pandemic. There's another factor at work, I believe, when it comes to high food prices now, and I think the president has spoken to this somewhat, which is the price gouging, in the sense that the profit margins of some of the big grocery manufacturers today exceed their profit margins before the pandemic. Is that an accurate statement?
I believe it is. I believe the Council of Economic Advisors has looked at this. I haven't personally reviewed that data, but I think that is true.
Which is one of the reasons the president's been so focused on going after price gouging in all its forms and junk fees. And I know the Treasury plays some role in that. Is that something you and your team are working on?
Well, we participate in economic discussions and policy making.
With the absolutely. Well, thank you for the role that you are playing. If I could just ask you about investor advisor reporting requirements, because you're often before the appropriations subcommittee that I chair, the FISG subcommittee, and we've had this ongoing conversation about the fact that you've got Russian oligarchs and other kleptocrats who have used investment advisors, including private equity and venture capital and hedge fund managers, to attempt to clean their ill-gotten gains. Now, you mentioned already the fact that we had the beneficial ownership law. I understand that just yesterday you've included some folks within the real estate area. But can you talk about progress you're making in this broader area of investment advisors? Because it is important that we try to close one door, but it doesn't do us any good if it leaves the back door wide open.
Well, investment advisors is a financial sector that hasn't been uniformly covered by AML-CFT requirements. There are some investment advisors who are brokers or may be covered by some rules, but there are certainly investment advisors that are not covered. And our risk assessments show that that is an area that provides an avenue for sanctioned individuals, for criminals and the like, to move wealth and invest in the United States without the sources of their wealth being detected. And
so are we making progress in terms of developing a rule to close this loophole?
Yes, we are. Absolutely. We expect to issue such a proposed rule soon.
Good. In my remaining time, I just want to ask you about the outbound investment proposals the Biden administration has put forward to try to prevent very capital from the United States helping to invest in China's military. This is obviously an effort that requires cooperation from our allies around the world. Can you just provide an update on where that effort stands?
So in response to an executive order, Treasury prepared a notice of proposed rulemaking, which it issued, that asks a series of questions and proposes both information gathering and some restrictions, indicates it's contemplating restrictions in the areas of artificial intelligence, semiconductors, and quantum computing, areas that seem to have a clear nexus to national security risks. And we've received comments and hope to come out with a notice of proposed rulemaking that takes account of the comments and closes down channels. I mean, we have export controls and other controls, but these outbound investments can be a way of providing aid to China's military or other countries of concern that need to be closed down.
I appreciate that, and just want to make sure we're also coordinating with our allies, because again, it's important that we do this in coordination. I think you would agree.
Yes, we are. We have work very closely with our allies and are urging them to adopt similar regulations.
Thank you, Madam Secretary.
Senator Vance from Ohio is recognized.
Thanks, Mr. Chairman. And Secretary Yellen, thanks for being here. I actually wanted to ask about something that's probably pretty far afield and you've stopped thinking about, but we haven't got a chance to talk about, and that's the SVB collapse and sort of the run-up to the acquisition of SVB by JP Morgan. Yeah, I want to sort of start just with a kind of a basic question. So to recap, the systemic risk exception was triggered for the SVB situation, which was clearly pretty dire, pretty significant. Because of the systemic risk exception was triggered, the FDIC effectively engaged in what I would call a bailout of the uninsured depositors, but whatever term you want to apply to it, the uninsured depositors were made whole. Obviously, the shareholders were not. But the argument, of course, is that somehow prevented a broader panic or bank run in the markets. And I'm curious, Secretary Yellen, if you could just take me back to that decision coming up on a year ago. Why did you think, given that SVB was so focused on obviously the technology sector, the venture capital sector, a sector I know well, why did you think that it posed a systemic risk to the economy, or why did you and the broader board decide that?
Well, we were concerned about contagion to other banks. And the source of the problem, I mean, there were really two things that affected Silicon Valley Bank. One was losses, mainly unrealized, but nevertheless obvious losses from a failure to manage interest rate risk properly. So interest rates had risen substantially. This firm had purchased longer-term assets, the value of which fell in a higher interest rate environment. And that was a risk that affected many banks in the United States. So that risk was not in any way confined just to Silicon Valley Bank. Many banks suffered similar losses. The other issue is that Silicon Valley Bank relied very, very heavily on uninsured deposits. And now we saw a pace of runs that was beyond anything.
Understood.
But other banks also, we actually have quite a high level of uninsured deposits in the banking system. And many Americans may have felt if depositors, uninsured depositors at SVB were haircut or their funds were immobilized in a resolution, that the same thing could happen to them at other banks.
Understood. So just one follow-up question to that, and if I have time, I'll ask about the CFIUS review of Nippon Steel acquiring U.S. Steel. But just quickly on this, if you could. So my understanding is that there were multiple bids when the SVB collapsed. There were multiple bids that were on the table for acquiring SVB and sort of its assets. At the time, the public reporting suggested that the difference between the JP Morgan bid and the next best bid was $20 billion.
I believe that you're talking about First Republic that went to JP Morgan, Chase?
I'm talking about SVB. Didn't SVB go to JP Morgan? Sorry, First Republic. You're right. My understanding from based on the public reporting is that there was a $20 billion difference between the best bid, JP Morgan's, and the second best bid for First Republic. Some of the follow-on reporting and some of the private conversations I've had and my staff has had suggest that the difference was about $1 billion. So two-part question. Number one, what was the difference?
So in terms of the bids, I didn't see those bids. There's a question for Marty Grunberg, who's head of the FDIC. But I will say under the law, the FDIC is required to accept the highest bid that reduces FDIC losses as much as possible. On the details of what the bids were, you'll have to consult with him.
So I guess the worry is I'm very worried about the three-tiered banking system in our country. You want small, medium, and large banks. Obviously, we have the G-SIBs, but I also want a healthy banking sector below the G-SIBs. And my concern here is that we actually didn't care enough about concentration in how that transaction manifested itself. And I guess the simple question is that because you didn't have the tools to analyze that transaction with concerns about concentration, or is that because you had the tools and just didn't use them?
So let me first say I share your concern and believe it's important to have a diverse banking system. I believe there were a number of bids by different banks for SVB and for First Republic. And as I said, I believe under the law, the FDIC is required to accept the bid that results in the smallest losses to the Deposit Insurance Fund.
Understood. Thanks.
Thanks, Senator Vance. Warnock of Georgia is recognized.
Thank you so very much, Chair Brown. It's been 14 years since the passage of the Affordable Care Act, yet 10 states, including Georgia, have not fully expanded Medicaid. Let me be clear, closing the health care gap is the right thing to do, but it's also the smart thing to do. It's good for our economy. In fact, a recent report from the Council of Economic Advisors concluded that Medicaid expansion increases the disposable income of those gaining health coverage. And for those who are listening and watching, I want to be clear that when we say expansion, we're not talking about a new program. We're not talking about spending additional dollars. We're talking about the fact that citizens in states like Georgia don't have access, that they're subsidizing health care in other states while their hospitals are closing. But the Council of Economic Advisors pulls into sharp focus the importance of this, the ways in which we can allow hardworking families to spend less on health care and more on essentials like food, diapers, and school supplies. Secretary Yellen, thank you so much for being here. Can you discuss how state economies have improved post-expansion, specifically compared to non-expansion states like Georgia?
You're talking about in terms of uninsured, individuals?
Yeah, how the states that have expanded Medicaid, how that expansion has improved the economies of those states juxtaposed with states that are non-expansion states.
I honestly can't give you numerical assessments of that. I haven't done that, but generally states that have expanded Medicaid have done better, and certainly the households in those states, and especially lower income households, have been relieved of burdens that allow them to spend more to support themselves and the economies of those states.
Here's what we do know about closing Medicaid coverage gap in Georgia. If we were to close that Medicaid coverage gap in Georgia, it would mean $1.2 billion in additional federal support that I secured through the American Rescue Plan Act. That money's sitting on the table. 600,000 Georgians in the Medicaid gap. It would mean 56,000 new jobs every year, with 12,000 of those in rural communities. And it would mean $6.5 billion per year generated in economic output. And so I'm hopeful, I remain hopeful that Georgia lawmakers will do the right thing for Georgians and close the health care coverage gap. I want to move on to another topic. The child tax credit and the earned income tax credit, which I helped pass through the American Rescue Plan, was transformational for millions of Americans, reducing the number of kids living in poverty by more than 40%. All in all, these provisions collectively lifted nearly 10 million children above the poverty line or just slightly below the poverty line. These funds help Georgians buy essentials like food, diapers, a coat for their kid, life-saving prescription drugs. But unfortunately, these provisions expired and we lost the dramatic gains we made in combating childhood poverty. The 2023 FSOC annual report noted that while consumer financial health remains positive, we are seeing recent indicators of falling savings and rising credit card and auto loan delinquencies. Secretary Yellen, the child tax credit was a tax cut that put money in families' pockets. What economic benefits do we see from policies like this that focused on reducing childhood poverty, including on families' ability to save?
Well, I think it had an utterly dramatic effect on households. And as you mentioned, it resulted in a massive reduction in child poverty. It fell in 2021 to, I believe, 5.2%, which is the lowest on record. And of course, it means that families had, many still struggling because of the pandemic, had the resources to support their children, make sure that they weren't deprived of the food and other support that they need to go on to lead good lives and be productive members of the workforce as they get older. And, you know, many of these payments went to families that were in dire need. It's a tremendously important support.
Well, thank you so much. I'm very much in favor of tax cuts for working families. And this is why we've got to restore the child tax credit. And this is why the enhanced child tax credit found within the Bipartisan Tax Relief for American Families and Workers Act is an important first step. And I hope we can get that legislation passed soon. Thank you so much for your
Thank you, Senator.
Thanks, Senator Warnock, and thank you for soon after you came here in 2001, we passed the most important attack on child poverty in decades, and thank you for your leadership role in it. Secretary Yellen, thank you. I know that this committee hearing and the preparation time for a hearing like this takes a huge chunk out of maybe the most complicated job in the federal government, certainly one of the most complicated. Every week, it seems, we learn about another responsibility that the Treasury Department has. So thank you. And thank you in light of what Senator Warnock said. I remember, and I still talk about the call I had with you after the president signed the American Recovery Act, and we passed it on March 6th. He signed it within a couple of weeks. Our conversation, you immediately brought in Commissioner Reddick, who was a Trump appointee, but who was reasonable and professional, and we got that moving. And by July, checks went out to the families of 60 million children, 2 million of them in my state. It changed the lives of so many, and it would change the lives dramatically if we could renew it as we're trying to do in a tax bill now. But thank you. For senators who wish to submit questions, those questions are due 1 week from today, the 15th of February. Then you will have 45 days, you and your staff, to respond to any questions. Thank you so much for your public service.